right, we are the last day of this March Madness when it comes to what has really roiled markets overall, and I think we're ending it with a bang with this latest Wall Street Journal report here this morning, where President Trump is telling its aides that he is willing to come out of this war here, even if they don't reopen the Strait of Hormuz. And it seems like at least right now we are seeing risk assets improve just a bit here this morning.
Yeah, I think it underscores how headline risk remain as far as markets go, and I think certainly this does provide an exit, and whether or not we actually take that path all the way down is still unclear. We've been looking at these ever-changing headlines and directions and conflicting reports, conflicting statements. We've gotten somewhat used to that over the last few weeks or so. But yes, this is the latest one that markets are reacting to, given this latest report coming out of the Journal here. Yeah,
so certainly you're seeing oil coming off a little bit here after we did see, after that Kuwait oil tanker that was bombed near Dubai. That certainly did lead to a lot of things getting a bit, concerning about maybe things are widening a little bit, and really you are starting to see more of these sort of military operations really hit key infrastructure. You're talking about tankers and the like. So then you had all the Powell sound too, right? That did actually calm the bond market a little bit here, just given the fact that it sounded a bit transitory-ish, his comment when it came to that sort of inflation pass-through as well. So there are silver linings to all this here right now, but yeah, it's all just very fluid here right now. We ripped up the strip, as you say.
Yeah, extremely fluid, and I think we'll just have to wait and see what the next few minutes hold. On top of that, right, keep in mind they're still bombing each other. I think I think something that is also somewhat tethered to actually what's happening on the ground there. Now, as far as markets go, we're only down 0.5% on the benchmark. We are coming off highs on oil, still up for the day. The dollar has reversed the early strength. We're now looking at weakness in the Bloomberg Dollar Index. How that shows up across major benchmarks, U.S. futures, the Nikkei, I believe, is now up after down as much as 2-3% at one point. Flip the page, please. Kospi Index, Taiwan is coming online. And interesting, because Taiwan is coming online after this headline came out, but also keep in mind that massive drop that we had overnight in tech stocks. So we are opening somewhat better than would have been the case 30 minutes back here. Kospi still down, though, 2.6%. And going into the Chinese Open today, A50 futures coming up on your screens. Also keep in mind, when you look at the bond markets, we are looking at a fifth straight, as of the close yesterday, a fifth straight day of China Treasury futures on the way up. So the rally is something to watch. And apart from that, nothing clear as far as futures go. So we are waiting with bated breath in as far as what the next few hours might hold here.
Okay, let's bring in our team to talk us through all the headlines. Our politics editor, Laura Davison, is here with us, along with our Bloomberg intelligence analyst, Henrik Fong, on the impact on oil markets. Laura, I'll start with you. So, ending military operations before even the Strait of Hormuz is open, how should we interpret that?
One not so generous interpretation is that Trump is growing bored with this war, but that is, what some had early on prognosticated. Trump even addressed that. He in the early days of March, someone had criticized this, saying, "Look, Trump's going to just move away from this in a month or so." He said, "Look, we think this is going to last 5 to 6 weeks, but I don't get bored. We can take this much longer." Now we're at week 5, and we're seeing, him looking for an out, particularly with a major loss, which would be if the U.S. were to step away from this conflict without some sort of resolution on the Strait of Hormuz. The Journal story suggested from their reporting that he is just going to leave that to Gulf allies and to EU allies to figure out what the next steps are. That gives Iran a ton of power over both this conflict and the next steps, as well as over the entire global economy.
Yeah, because they hold the biggest gun. If they're stepping away, that changes the power dynamics altogether. Meanwhile, we just talked about this too. The latest on that Kuwait tanker that got hit early this morning.
This is another example of Iran really flexing its muscles. This is now the second in 2 or 3 days of them having really precise targeting, hitting that U.S. Big jet that is sort of a flying command center a couple days ago. Now hitting this tanker, in Dubai. It's off the shore a little bit, so it's not directly in the marina. But that's a clear warning signal that, look, we have the ability to target some of these assets, and we're going to use that capability, which really runs in contrast to what we've been hearing from the Pentagon and the U.S. side, that Iran's military capabilities are completely obliterated. They've still been able to really make some attacks that have really roiled markets and caused a lot of concern.
Henrik, I mean, the fact that the U.S. might pull out of this war without reopening the Strait of Hormuz, does that just keep oil markets elevated for a prolonged period?
Well, I think geopolitics will become the key theme for this year. So, with or without any other development, I think oil price will still be staying at high level because the market is trying to price in this risk in form of high risk premium. And from the recent events like the Houthis attack against Israel and also this morning's Dubai oil tanker fire, I think the market is trying to price in this uncertainty. And this is not just affecting the short-term supply-demand outlook. It's more on the long term. How this will shift the demand in terms of the SPR bill and also how this quicken the energy usage.
We actually want to get your thoughts on if we go down that route that the Red Sea now becomes more involved with the Houthis in a moment. But Laura, just on that story, that we understand the Iranians and the Houthis are now looking to escalate this into the Red Sea. What do we know exactly about? And there was some speculation around this 24 hours ago, but what do we know now, 24 hours on?
So it's really Iran that's driving the boat or the ship here, pushing the Houthis to essentially kind of blockade the Red Sea. That would also you really get to a game of traffic jam in the region there on the waterways. Bloomberg Economics estimates this would push oil to about $140 a barrel. So again, a really big and significant impact. Just as there's almost no way to move throughout the region safely. However, we have this reporting also suggests that there's a little bit of division among the Houthis about how boldly they want to play, how much of an impact they want to have. So there's still a degree of uncertainty about whether this would be sort of a full closure and kind of what their capabilities are, different from what we've seen in the Strait of Hormuz of essentially an entirely blockade.
Yeah, and quantify that for us in terms of, because this was the plan, or this is the plan B.
The diversion.
The diversion into the Red Sea. So what happens if that becomes largely closed off?
Well, if both waterways are closed down, they account for over 20% of the global oil export volume. So they can, send oil price to 150, 160 in a day or two. But I don't see that situation that bad yet because, I think they're just showing that they have the military capability of, telling the world that they can control the area. They can hit Israel. They can hit any targets in Red Sea. They can, if they want, they can create massive energy supplies shock to, send energy prices higher, to push up, inflation. So this is something they want. And I think Iran knows very well that if oil prices going up to 150, 160, that's not going to do anyone good for that because demand destruction is going to come down. So what I think they would do is that they want to keep oil price at 100, 120 level. They can get some pretty good, oil revenue. At the same time, they can put pressure on U.S. in gas price. And some of the examples is like over the past few weeks, they let China-linked vessels pass through the Strait of Hormuz. They let Pakistan-linked vessels passing through. So I think they will still let the oil flow going out, from the region, but they just want to limit that and to keep price high.
So if this potential does happen, right, the fact that the U.S. pulls out, is it just down to Iran and Israel to really kind of, in some ways, battle this out? And how does that change the whole game? In some ways,
it definitely strengthens Iran's hand, both rhetorically because they were able to essentially fight off the United States and have them walk away with a major loss. Plus, the capability that the U.S. brings to the table. Israel has a very strong military. However, it could sort of the silver lining here, if markets are looking for one, is that this could create an opening for other Gulf allies or the Europeans to get more involved. They've been really, really reticent to. They don't really want to play by Trump's rules. He's been making a lot of demands that they have just completely rebuffed. If the power dynamics shift here, and as this goes on longer and the risks go higher, there's a potential for sort of a different coalition to form.
All right. Laura, thank you. Laura Davison and Henrik Fund there joining us from Bloomberg Intelligence. Of course, of what to expect here. And as we've been tracking, of course, this latest headline from the Wall Street Journal about what the U.S. is thinking about, whether it's exiting this war without reopening the Strait of Hormuz. We'll be digging into the impact of the conflict with all of our guests here this morning. Of course, we'll start with Franklin Templeton's head of Global Index Portfolio Management. Dina Ting joins us just a moment. Plus, SocGen's Global Chief Economist Wei Yao joins us a little bit later on with their outlook on inflation and growth. And we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Just an update of the breaking news and hence why U.S. futures have changed their course. This journal headline that just crossed, we're just trying to figure out as well, markets are trying to figure out globally whether or not this does present the most feasible off-ramp. With all that being said, it is somewhat of a confusing end to what's really been a manic month, and it's really been a terrible month for risk assets. In fact, when you look at how we've done on global equities this month alone, it's the single biggest month in terms of value destruction on record. Close to 12 trillion in market cap has been wiped out across our benchmarks of market cap at Bloomberg globally. And as you can see year to date, we've now erased, if not more, gains for most asset classes for the year. And this has taken us back a few months in terms of price here.
I mean, the fact that this is even bigger than what we saw during the Russian invasion of Ukraine back in 2022, even bigger than what we saw in COVID of 2020. I mean, that certainly does show really what we've seen is that, are we still at this point, some people are still wondering, are we still underpricing the risks to not just supply, but also potentially the demand destruction that could take away, given the fact that even if we see President Trump saying, I'm done, even without the reopening of Strait of Hormuz, you're still talking about energy infrastructure, oil infrastructure that has to be repaired. That could take months, even years. So I think the longer term implications are certainly the one thing that we have to really deal with here. And what does that mean for, investors in portfolio construction?
Yeah, and in fact, let's get the thoughts right now of Dina Ting. She's with us right now. She's head of global index portfolio management at Franklin Templeton. Dina, good morning, and a pleasure to have you join us right now. I'm not sure what kind of months you've had. It's really been manic across most of us here in the Asia Pacific here looking at these markets. But to tell us, the month that we've had in terms of market moves and value destruction, is there a dip you are willing to buy at this point? What would you buy? What would you stay away from?
I think the way investors should look at it is looking at the long term, right? And also at the horizon. So you mentioned the month, but if you look at the year to date, there are some markets that are still posting positive number for the year to date number. So I think it's about where the war will potentially end and also how each of the different asset classes as well as specific country are positioning, because it's not impacting everyone the same way. And I think it shows that diversification really pays. On top of that, strategic planning for each of the country or who can best plan with the different contingency, you can see that in their differentiated performance.
So which are those sort of, markets and sectors that you look at, right? If it's not going to be, single haven sort of hedging, what are sort of the beneficiaries of this then?
Yeah, so I think the way to look at it is looking at the specific countries. So if you look at China, for example, they are less impacted in this. And part of that is because of their strategic diversification of their energy supplies, both into different locations, but also into renewable energy. They also have a huge stockpiles that have strategically been put together. And I think people realize now the dependence of oil may not be the best bet. And you've seen the data now that electrification could actually be cheaper. And China is one where you can potentially play in that sector, not only for their own country and their own economy, but also for the rest of the region, outside of Asia, as well as in Africa.
Okay, again, sorry to circle back to my initial question. What do I buy then?
Yeah, so I think for investors to look at is trying to disaggregate the exposure globally, right? So if you look at specific, you can go with sectors, you can also go with single countries. So if you disaggregate international market and see how they play, you can look at markets such as China, you can look at Taiwan, you can also look at Brazil as a potential diversification to your typical allocation. So on top of that, if you look even more at the top line, you can also look at the correlation across all the assets, because in periods of volatility, not only you zero in on the specific asset that has lower volatility, but you also look for uncorrelated asset. And if you look across different markets on the equity, that level of correlation actually has decreased, which is a good news for investors to be able to get the pieces and create a portfolio that is diversified but less correlated. And I think that's where ETF come into play, right? There's a lot of ETFs out there, from single country ETF to income tilted ETF, but investors can see and be able to allocate very quickly to get the targeted exposure, but also using it as part of the whole portfolio construction to balance correlation and liquidity, as well as the overall risk and return from the overall portfolio.
Dina, you mentioned something about AI as the sort of offset to the fragmentation of global trade. I was going to get your take on that, because it seems like the narrative around AI is ever changing by the day. One day it's the software companies and really being the disruptions and being disrupted. Another day it's memory chips that we saw overnight in the U.S., where now there's concerns about excess capacity. There's concerns about CapEx fatigue. What are sort of the AI narratives that we should be focusing on for 2026 now?
I think in an AI story, it's important to understand the different layers of AI. When people talk about the buildings and the infrastructure, that's the semiconductor chip that powers that, that's the electrification to have the gigafactory. Those are investments that they are all making right now. Now, there's debate about whether that's over $1 trillion or some other numbers, but they are all making that investment. And then the second layer is even more important, because that's like where the intelligence are being built. And then if you go to the top layer, it's actual applications. So you're not limited to just the technology itself, but it's actual business implementation on how AI is powering the economy and the specific companies that are using it in order to create a real efficiency and that will translate into profitability. So at the end of the day, the number will speak for itself. But for investor, it is true there is different narrative. But one thing for sure, everything has to start from the building blocks, and then, but each of that realizing where it fits and where the opportunities are.
Dina, thank you. Dina Ting there, Head of Global Index Portfolio Management at Franklin Templeton. Your pre-market for Hong Kong is up now. We're taking a look at when it comes to how the Hang Seng is doing. We actually are seeing some positivity here. So we're up about 1/3% here. Futures are all punching just slightly higher here after that Wall Street Journal report that President Trump telling his aides that he may be open to ending this war without reopening the Strait of Hormuz. You are seeing here a bit of a reversal here in just the last hour or so when it comes to risk assets. Their equities now finding a floor. This is Bloomberg.
Okay, there you go. Brent prices, oil prices are coming off their highs quite visibly, and it's also the case when you look at the U.S. dollar, which I guess just underscores somewhat return of risk appetite going into this Chinese Open. In fact, you have U.S. futures, European futures. Asia is now, if I'm not mistaken, should be up or just slightly lower for the day going into the Open today. Yeah, there we go. So we're now down just 0.3%. If you looked at this an hour back, this would have all been completely red on your screen. So this journal reports that the U.S. president is willing to end the war without reopening the strait is, I guess, somewhat food for thought, but it is something that markets are running with currently. Well, let's see, of course, whether or not that is the route they eventually take.
Yeah, this could be the sort of short-term knee-jerk reaction. We'll see, right? We still have to deal with that, sort of these stagflation concerns in the longer term. But at least for now, it seems like there is at least a little bit more urgency from the U.S. side to end this war. But what does this mean for when it comes to Iran and their ability and leverage to really control this vital waterway? And what this means for the global economy certainly is going to be a big question there, too.
It really is. And, just keep in mind, we're also in the thick of earnings season, and I think some of the stocks we're tracking today separately would be Moutai. I think one of the names to watch going into the the open later on. I think they raised prices too.
Retail prices of their flagship liquor for the first time in 3 years.
Feitian, right? Feitian Moutai for the first time in 3 years.
Positive surprise, as some analysts have said it.
Yeah, okay. Well, the sort of slightly on the lighter side comedic juxtaposition for that is fuel prices have really seen a bit of upside of late. If you know, you know. If you tasted that, fantastic, by the way. But yes, it's not for the sensitive
you might
parts.
need some with these markets and the volatility.
Okay. Well, speaking of oil. Coming up on your screens ever shortly. And of course, we also forgot it is PMI day, so that's going to come out, of course, in the next few minutes or so. Keep an eye on that. Apart from everything else that we're talking about, we're still watching these headlines. As we
it's
make our way to the open.
It's not just the oil story, and it's also the tech story, right? I mean, it was supposed to be a double whammy for Asia today, given the fact that you had Micron fall some double digits overnight, with not really a clear trigger, really the memory names. So certainly we'll have much more to talk about here as well. We got PMI, as Dave mentioned here, just about 4 minutes time, and the open is coming up next. This is Bloomberg.
Right, welcome back. You're watching the China Show. We're counting down to the open at markets, and we are actually on better footing than we were 30 minutes back compared to that point, better than 30 minutes beyond that point. This Wall Street Journal report of the U.S. president willing to end the war on certain conditions is really something that markets are latching onto currently.
Still, I think the superlatives are still important to know about what craziness we've seen this March, right? When you're talking about the biggest wipeout in global stocks ever for March, and really kind of surpasses what we saw with COVID, surpasses what we saw with the Russian invasion of Ukraine. That certainly does tell you something about the demand, or at least the risk sentiment, and really the concerns about stagflation are certainly there. But then again, you had Jerome Powell also talking about, look, it might be transitory, right? They're not too worried just yet. So that at least soothed some of the bond traders' concerns overnight. But certainly, this Wall Street Journal report was dominating the headlines here this morning about, President Trump seems urgent to want to really end this war, even if it means the Strait of Hormuz is still shut. What does that mean? Well, we do see oil coming off a little bit as well, and Shanghai crude futures are falling. What we saw with Brent and WTI were lower by about 1% here as well. Risks, when it comes to, risk assets are doing a little bit better, but China has been actually pretty flat, given that, usually on down days, China is relatively looking better. I think right now, we're pretty just subdued right now. We're watching very much the chip space, given what we've been seeing. It seems like that tech sell-off that we saw overnight is coming to Asia, has come to China as well. Capricorn Tech is just slightly lower. But interesting to know about Midea Group as well. Earnings did come in line with estimates according to Morgan Stanley. And they're also pivoting away from home appliances, given the fact that, they're going to be seeing rising material costs and the like, and into more tech. So stock is up some 4% here as well. And we're watching Kuwaiti Moutai. There you go, 3.8%. So there's reports that they've hiked their retail prices for their flagship liquor. First time in 3 years. So pretty positive surprise there as well. So drink up there today, up 4% for Kuwaiti. Let's flip the boards and see what Hong Kong is doing, because there is that tech story certainly that could derail. But there again, there you go, HS Tech. We're actually doing okay. We're up about 0.7%. What's driving that is Tencent, Alibaba, Baidu are all seeing gains of 1%. Xiaomi is the exception here today. We have those PMI numbers just dropping our terminals here right now, and better than expected for March.
Yes, both on the manufacturing and the non-manufacturing reads here coming through as well. So March manufacturing coming in 50.4, estimates for 50.1. The non-manufacturing gauge coming in above that 50 threshold at 50.1, just barely, but the estimates for just barely below that at 49. At 49.9. I'm just looking at what that 50.4 actually looks like in terms of a trend. And yeah, so 50.4 actually would be the highest PMI print going back about 12 months ago. There we go. So 50.4 is quite something. And, we were talking about this on Monday, right? We were going to get a slew of global PMIs this week, and we were wondering whether it was going to reflect initially the changing sentiment around the war among manufacturers or supply chain managers, what have you. But certainly with this, it doesn't seem, well, at least specifically in China's case, doesn't seem to be the case.
Yeah, maybe March is where you start to see, right, the the people might be responding to what we're seeing with the Iran situation. It seems like right now you're still seeing expansion when it comes to manufacturing and non-manufacturing. What does this mean for the rest of the world? Of course, let's bring in Wei Yao, global chief economist at APAC at Societe Generale. How are you assessing the pass-through inflation right now from international to domestic prices, and what really Asian economies have been doing to try to cushion the impact right now?
I think the China PMIs we just got, basically show the point that the global economy, U.S., Europe, Asia, all have had a resilience coming to this crisis.
Yeah.
Right? It was very much supported by the AI-driven trade. That was a very big driver and kind of push. So now the question is, how bigger this shock can get to derail this momentum. So we have some buffer, but this buffer is not unlimited. I think China is definitely in a much more resilient place, right? So they have the SPR, they have, they have their petrochemical that can run on coal. This sets China in a bit different place from the rest of Asia. I think Asia definitely is more fragile in this situation. But I would be watching most closely looking at Korea and Taiwan because they're at the center of this AI trade. Whether their momentum, their production, their manufacturing will be affected by this oil shock actually will mean a lot for the global cycle.
The way you phrased that, then I think the follow-up there would be how useful then would be March data to extrapolate how we would do in April. In other words, is this somewhat still valuable information right now, how we did before the war? What is there anything that you can predict now with a degree of confidence? Okay.
The degree of confidence is low because the uncertainty level is very, very high, right? Especially at this moment.
Right.
This is, I think, we're the 5th week into this war. We're getting to the most dangerous and most confusing time. It's dangerous because any further escalation will bring a lot more lasting, permanent physical damage, right? It's not disruption anymore. It's confusing because we're getting signals on all kinds of scenarios, right? Yeah. So right now, macro forecasting is impossible, essentially. But I think the data that came out in March, for March, still valuable in the sense it tells a lot about the starting condition, right? So for the growth, we have resilience. But for inflation, that also means, the central bank indeed have reason to be very careful with inflation because, the growth was on an upward momentum trajectory. The excess capacity is actually less, right? So they need to be more careful with inflation risk. Yeah.
But can they actually hike rates? If there is a demand destruction possibility.
That's central bank's job, right? Their job is to manage inflation. But I guess...
Is it inflation or inflation expectations? Because there seems to be a difference.
It's both, right? Okay. Once you're having inflation expectation, it gets more entrenched. Then you get inflation. So unfortunately, I think, central banks, they're institution run by human. So they look at the recent history. And the recent history is that they were too late after the Russia-Ukraine war in containing inflation, right? So you do have these institutions now probably have the tendency to care more about inflation in the near term. Yeah.
I want to talk more about the Asia Pacific. Then we can talk about this relative resilience that China is exuding. Right. So markets like Korea, Taiwan, you mentioned that, some economies in South Asia, Southeast Asia. What kind of demand destruction realistically do you think we are seeing, and how do we look at that risk without throwing the baby out with the bathwater? In other words, without pushing the panic button. What is a realistic assessment right now of how those economies will likely fare over the next 3 months?
So there is a relatively simple framework to look at it, right? Is that the economy needs to consume certain energy to produce certain output, right, for the intensity. Then the problem now is not just oil prices are more expensive, right? If you can buy, if you can pay for that price, so you can limit the demand destruction. That's actually less problematic, or there is certain less demand destruction you can have. The challenge for these countries that doesn't really have the fiscal power or just income to do that, then they will be forced to do demand destruction. Then it's no longer about the elasticity question. They just have to do it. Right? What I mean by that is that While Europe, for example, in Asia, right, I mentioned earlier that Korea, Taiwan watch very closely. But at the end of the day, I think they're able to pay for this price. Whereas some other countries, especially in the South Asia, I'm not talking about India, some even, poorer country, right, Pakistan or Bangladesh, they essentially wouldn't have any choice. So, so the distribution of the burden will be very uneven, essentially.
We talked about China being somewhat insulated. They have cheap energy.
Diversified.
They have diversified. And maybe this is the inflation that they need. But is this the inflation, the good inflation that China needs?
I wouldn't really say it's the inflation they need. Because I understand how there is a certain way to look at it to say, okay, China needs some external factor to lift it out of deflation, right? Like Japan. But the problem is the Japan situation was all stars were aligned. There was demand, there was fiscal, there was monetary, right? There is tight labor market. Then there is the external shock. Then you can get out of deflation for good. Whereas China right now, all these conditions, what do you have? External factor only, right? Okay, we're getting a little bit better demand. That's what we see in PMI. A little bit better fiscal, bit more monetary, but at the end of the day, you still need more demand-driven inflation, more kind of labor market wage dynamics to be sustainable. So,
that's the strange thing when you look at how what's caused inflation to come back in the last 5-10 years. It's not what you would have expected, right? You had the pandemic, you had this massive fiscal package out of the U.S. In Japan's case, we were waiting for 15 years and suddenly it showed up, not in the form. So I guess my question is, we were having problems bringing inflation back below target going into this war. And now we have this. Does this exacerbate the inflation problem moving forward? How do we need to be looking at rates 12, 24 months down the road?
Yeah, for the developed market, there is definitely this problem. Right? So talking about the starting condition, right? The starting condition in the U.S. is, as you pointed out, the inflation is not back below target. The starting condition in Europe is that the labor market is at the tightest level in many, many years. And starting point in Japan is, it's getting out of deflation and entering seemingly very sustained reflation phase. So that's the inflation risk that the central bank cannot ignore, even though it will hurt the economy if they tighten. But they simply, I don't think they have a choice. The other challenge is also that the fiscal scope is more constrained now compared to, the 2021. So I think the market, in a way, is moving in the direction of worrying about stagflation. That's not wrong, but I do think at this moment we still need to see how this war turns out because, some expectations a bit excessive.
We just had a guess that the AI sort of trade is what's offsetting what we're seeing in global trade. But do you think this could also derail the whole AI boom? As well, I know you said you're focusing on the data from Taiwan and Korea in the next few weeks or months.
Yeah, that is a risk at this moment. I don't see this as a central scenario. I think AI boom can survive it. Because at the end of the day, it is about the purchasing power, right? The ability, the financial capability to spend more money on this long-term project, right? So at this moment, you look at the big companies in the U.S., they are the drivers of the whole thing. They still have, money to spend, and they still want to do it. China wants to do it. Everyone still wants to do it. So, so it has some resilience in terms of the AI momentum.
Let's end on something more positive. How are you doing on your forecasts? Growth and inflation.
That's more positive.
Is that
well, that depends on what the direction of travel is.
I just think, in this kind of scenario, we have to admit that, we're faced with uncertainty, right? So we have to provide dot forecasts, but I'm more thinking in terms of distribution of outcome. And at this moment, it's very scattered, it's very polarized. So we just have to be humble.
Okay. That's a good starting point for many things. But thank you so much. Global chief economist there at SocGen. Okay, an update here on the Kuwaiti oil tanker, which I think just after midnight local time was hit about 30 nautical miles northwest of Dubai. So the fire has now been extinguished. It's based on this post text post from the media office out of Dubai.
And this was a direct hit, as what we had earlier reported from Iran. So certainly now that seems to be, that situation is stabilized just a bit here, according to what we're hearing from Dubai. But then again, markets seem to have moved on from this story now. We thought this was going to be probably our top thing to talk about, but now this Wall Street Journal report seems to be at least helping out when it comes to, maybe markets are pricing in the possibility that this war could be over soon. See how U.S. futures and NASDAQ futures are looking at, right? We're up and punching close to 1% right now. This is Bloomberg. All right, we're checking when it comes to Asian markets here today, and we're doing a little bit better here. We're coming off some of the initial lows in the sessions there. We're up now in Japan by about 1/3%. Kospi is still lower, but we have seen things improve just a little bit in terms of sentiment. HS Tech is also up as well, just given what we heard from this Wall Street Journal headline from President Trump here, maybe looking to end this war, even if the Strait of Hormuz remains effectively shut here right now. But yes, what we've been focusing on has been, of course, that tech story too, Dave, which was pretty ugly overnight. It
really was. I think when you look at the sell-off across, I think Micron took a substantial hit among just the other peers as well on the Philly Semiconductor Index. In fact, just when you look at some of how they've been doing, massive price reduction overnight. So the implications really of this turbo quant out of Google, and investors are assessing the impact of that and what that really means. Let's bring in Belle with us here on set to talk us through this. Yeah, so what are we seeing in the Asia Pacific, and how do we look at this new development out of Google?
Yeah, it's an interesting one because actually I wasn't expecting tech stocks to have fared so poorly in the US overnight, just given the moves that we had in rates and changing expectations around the Fed. But it really was quite a significant sell-off, and it does seem that investors are still really trying to come to terms with exactly the implications of Google's turbo quant that was actually published at the end of last year, but only started being publicized last week. And so that's why it's sort of been this sort of delay. I think just to get back into the technical details of it, there are a lot of them, but at a headline level, right now a major issue that we have in AI generally is just how much memory is needed for the LLMs to function essentially. So every time you type something into a model, it has to have a lot of recall, especially if you're trying to get it to go through big documents or to retain a long conversation. And so that takes up a lot of memory. And so what TurboQuant manages to do is to significantly reduce the amount of memory that's needed. They're saying by a factor of 6, but also maintain the same level of performance. And so investors overnight seem to have been thinking which type of memory is going to be most affected here, because last week we were talking about the HBM story being more affected, but overnight it's sort of there's a changing assessment. Actually, it's flash memory, which is more of the short-term recall and storage, that could actually really be in the firing line. And so saw some of those names that are sensitive to that sector in particular really bearing the brunt of it. But this is really just research stage right now. Yes, it could have profound implications, but it hasn't been deployed widely just yet. So just traders just again still trying to come to terms with it.
Yeah, if you take a look at who might be impacted the most, I mean, Kyocera in Japan, you mentioned is particularly vulnerable, but this has been a darling among many investors, this stock of late. Yeah,
it's an interesting story. Yeah, Kyocera is we've seen a huge amount of interest in this company from hedge funds and also from day traders as well. A lot of it is actually just on, just like single day turnover of the stock. And when you compare it against the peers in Japan, it's way at a record in terms of the amount of interest in it. One of the reasons that people are so enthusiastic about it is just because they see a huge amount of earnings growth. And yes, because it has had that AI story that's really underpinned it. You can see here, first 3 months of this year, around 36 trillion yen of turnover versus some of its peers in the tech space in China. So just to reiterate, I mean, people are saying that even with this concerns now around TurboQuant, the outlook for the stock is still strong, but just when you've got that amount of interest in it as well, volatility is likely to remain elevated.
All right, Belle, Annabelle Jewelers there, a Bloomberg Tech correspondent there for Asia. Of course, we'll be talking not just the tech space, but we're moving on and talking a little bit more about earnings as well. We're sticking into biopharma and the like here. CanSino's chairman and CEO, Xuefeng Yu, he's going to be joining us later on in the 10 hour. And we'll also be talking tech and AI with 01.ai CEO Kai-Fu Lee on the latest disruptions he's seeing in the sector. Those exclusive interviews coming up at the Times on your screen. Well, HSBC CEO George Al-Hedari says he has been ruthless about killing complexity as he pushes through an AI-fueled overhaul. He told us the use of the technology is not optional and explained why learning AI skills will be crucial for banking professionals.
We now rolled to 170,000 of our colleagues internal productivity tools that can materially improve their capabilities of reading documents, reading emails, writing documents, emails, querying, challenging,
the dream
process. 170,000 of our employees. I mean, soon all the way to the 200,000+ employees. But for the moment that's in the rollout phase, we've already reached 170,000. Of course, I will be monitoring usage. I'll be monitoring super usage. Those will be the most, kind of influencing among their colleagues to drive the utilization. But utilization is not optional, because that's how people remain very relevant in the future workforce 5 years down the road. But we're using Gen AI in wealth, we're using Gen AI in markets, we're using Gen AI in contact centers, we're using Gen AI, of course, in technology. Now 30,000 of our technologists, engineers, are enabled with Gen AI. The speed at which we're able to patch for, say, code weaknesses or kind of vulnerabilities is 10 times faster already now with coding assistance than it was the case last year. 10 times. And we're not talking
in 12 months.
In 12 months. We're not talking some productivity in 5 years. We're talking productivity already here. We're already 10 times faster at identifying and patching some of these vulnerabilities in our code. This is hugely transformational. So you can imagine how important it is. Now I go back to the first part of your question, Francine, is what are the skills that are needed for banks? I would say there is no one particular skill that's going to be critical, but it is going to be the ability to learn. Because you can come in a bank coming from an engineering background, from a technology background, from an accounting background, from a finance and economics background. You can even come into a bank somewhat from a different field than directly related to banking. But once you're in the bank, your career, the customer's expectation are such that you're going to have to continuously learn. And if you think you know it all, then there is no place for those, in an evolving landscape. It's very important to continuously be ready to learn and put in the hours and the effort to learn something new, a new skill, an additional skill. Today, the most important learning capability is how to best embrace Gen AI and innovation in general.
Yeah, there you go. The CEO of HSBC, George Al-Hedari, with, of course, our colleague, Francine Lacqua there, Bloomberg Leaders with Francine Lacqua. There's full version wherever you can get, of course, your favorite podcasts. You can check that full conversation out. Right. Just a brief look at these markets. So we're doing better. In fact, we're now up across some. The Kospi is continuing to sort of ease out of that big hole that it dug itself in the early goings. As with Taiwan, I guess it also helps that the PMI numbers coming out of China were surprisingly good. It really beat estimates. In fact, it came in at the highest level in about a year or so on manufacturing PMI. Yeah,
as Sakjen said, right, we came into this Iran situation with resilience. And so there is that bit of cushion here for the months and weeks to come here. But we'll have plenty more coming up. This is Bloomberg.
The degree of confidence is low because the uncertainty level is very, very high, right? Especially at this moment.
Right.
This is, I think, we're the 5th week into this war. we're getting to the most dangerous and most confusing time. It's dangerous because any further escalation will bring a lot more lasting, permanent physical damage, right? It's not disruption anymore. It's confusing because we're getting signals on all kinds of scenarios, right? Yeah. So right now, macro forecasting is impossible, essentially.
Macro forecasting is impossible, according to Stock Chen's way out there. Yeah, speaking to us earlier and basically saying it's time to be really humble at times like this, given that the uncertainty out there, right? Right now, at least today, we're taking these headlines from the Wall Street Journal as a good positive sign that maybe President Trump is willing to end this war, even if it means not reopening the Strait of Hormuz. But we are already coming off some of that little bit of momentum here already here in Hong Kong, Dave.
Yeah, we are, and I think we just keep. I think we have to keep going back to, and I think the concept changes the longer we wait. But we have to keep going back to how does the economy look if it ended tomorrow? And we have to keep asking ourselves that every day. And the longer that gets, right, the bigger the damage to infrastructure you'll get. And I think for Southeast Asia and South Asia, right, you are literally getting people getting out of their house less, you have mall hours getting shortened, you have work from home days of government, and that's going to eat into output for March in the first quarter, right? So like these forecasts are likely going to come down before things get better. As
Wei Yao mentioned from SocGen, right, it's going to differ, the central bank reaction functions because of that, right? Maybe larger economies like the Japans, the South Koreas, the Australias, they have the ability, they have the reserves, even China, right, to really weather and cushion that impact and really kind of try to cushion the pass-through from inflation. When you have smaller economies that, as you mentioned, right, are either lining up for fuel or telling people to limit mobility and the like, I mean, that, maybe rate hikes are the only sort of option that they have, even if it means that this could really lead to a lot of demand destruction out there. And it's not those economies and countries' war, but they're paying the most cost on this, right? So I think what Wei Yao, spot on, what Wei Yao is saying, it's really the poor that's bearing the brunt of this. And I think we were having this conversation with a guest yesterday. And, what does it mean in terms of the political capital, if that is something that we can talk about, of course, at this point, of the White House? When you look across the EM world, and I think, we have a date, right, for the Trump-Xi summit in about, 6 weeks from now? Like and to what extent is there still capital there to go, here's something that we needed to do in the Middle East. We can debate on the reasons for that, but here's the price. Here's the bill that everyone needs to split, right, at the end of that meal. But anyway, that's just getting into the complexities of things. The point Yvonne and I were making too, like the headline risk across these markets, right? When you look at how oil prices open higher, now lower, and we are starting to come off lows of the day. Dollar is similar story. Stocks are doing much better, although we are also coming off the highs of the day as far as some of the benchmarks are concerned. U.S. futures coming up. To the right side, you have MSCI Asia Pacific. So it's really headline driven and where we are here. And I think there are two narratives right now when it comes to what's going on there in the Middle East. Yeah, first it's, of course, what the Wall Street Journal is reporting of what President Trump is telling his aides. And then there's, of course, what happened a few hours ago, which was Iran striking this Kuwait oil tanker near Dubai. So let's go straight to Dubai there and bring in our Horizons Middle East and Africa anchor, Jumana Brzezinski. Jumana, it seems like markets are more focused on this Wall Street Journal report for now. Tell us what this means. What President Trump wants, which is exiting this war without reopening the Strait of Hormuz.
Well, that's exactly it. And to be honest, in the last 24 hours, he's spoken to many journalists and seems to be throwing out a lot of options, essentially seeing what sticks here. But the latest headline to cross a couple of hours ago came from the Wall Street Journal, where he told his aides that he's considering wrapping up the war without fully getting to a resolution on the Strait of Hormuz and perhaps leaving it to a broader diplomatic effort, joins the U.S. alongside other allies to come up with a solution there. And yesterday was interesting that Secretary of State Marco Rubio once again spelled out the military objectives of the war in terms of their nuclear objectives, the military objectives, the missiles, the funding of the proxies, which are very similar to those negotiating terms that they had set out even before the war started. Notably, and many people picked up on this, the reopening of the strait was not included in those lists of objectives. And I think perhaps there is an understanding now from the White House administration that you might have to separate the two. You have what you're trying to achieve with these joint U.S.-Israeli military operations, and certainly they're framing it as having been very successful so far. Even President Trump over the weekend said they've managed to strike 10,000, 11,000 targets. They've got about 3,000 targets to go. Whereas as it pertains to the Strait, and clearly this is becoming a new sticking point, there is a realization that perhaps the U.S. can't forcefully do this alone. If they do militarily, it's extremely risky that it be exposing these Marines to an inordinate amount of risk. And at the same time, because of its importance globally to the rest of the world, he seems to think that other nations will be willing to participate in some form of a coalition to open it up diplomatically. But I will just say, this would be very difficult to sell, and not least because you have the likes of many Arab states, including the likes of UAE, likening what Iran is doing to the Strait of Hormuz as economic terrorism. It is very unlikely to see Gulf Arab states be happy with a situation where the outcome is that Iran is still effectively controlling the straits here. It would be actually probably the worst case scenario for them.
And Jomana, talk to us then about the significance and the incident, which I believe took place just after midnight, your time, of this Kuwaiti tanker just off Dubai, and whether that represents, I guess, in some ways, Iran's hold on the oil story specifically.
Absolutely, David. And this is a really significant development as well, because it is a reminder once again that Iran is not only effectively controlling who passes through the strait, but are also jeopardizing and harassing vessels who they deem are not from friendly nations, or what they would say are hostile nations. In the past couple of days, they've been attacking Kuwait very, very hard. It's gone under the radar, but they had a desalination plant yesterday caused limited disruption. And then overnight, what we understand is they also targeted a vessel that was laden with crude oil. So it actually had oil on it. Off the coast of Dubai. Now, the Dubai authorities a short while ago, this is just a couple of minutes ago, said that they had managed to successfully extinguish the fire. KPC, which is the state-owned oil company, have actually said that the vessel was set ablaze, and at this point we don't understand how much of an oil spill this might result in, which could be a key and crucial environmental point to consider as well in the coming days. So we don't have full information on that. But the point is, it's just another reminder of the risks that are being posed to vessels, to tankers that want to transit the straits, and in most situations have been unsuccessful. The only ones that are managing to get through are either Iranian allied or have paid a fee to the Iranians to get through.
Jomana, thank you so much. Jomana Bersetchi there in Dubai for us, Horizon's Middle East and Africa anchor, with the latest on those two stories, that markets are really trying to carve out mental space to balance and really which one to place more weight on. Matt Gertken is with us now, Chief Geopolitical Strategist at BCA Research. He actually thinks Iran's targeting, that Jomana just pointing out there, of shipping is actually the key signal to watch out for, rather than the rhetoric coming out of the White House. Matt, a pleasure. And thank you, by the way, sir, for joining us. Good morning from the Asia Pacific. Why focus on Iran and not so much on the White House?
Well, thanks very much to both of you. Obviously, President Trump is still trying to balance domestic politics in the election with this military operation, and so that reduces his leverage in the short term. Over the long run, the U.S. has the capability, along with its allies, to seize back control of this chokehold geographically and to clear free passage for ships and tankers. But in the near term, the president is sort of trying to do a diplomatic solution, or trying to avoid escalating the economic shock that's going to ramify back on him and his ruling party.
But what happens? I mean, if the U.S. does pull out of this, and that essentially does leave Iran to keep on having this tight grip on the Strait of Hormuz, I mean, what would it take, Matt, to really reopen this waterway now?
Well, see, that's the thing. Is so the Kuwait tanker that was just struck off Dubai, which you all have been talking about, that's the real critical signal, because remember that it's now been a week since President Trump sort of pivoted and started trying to move toward negotiations. He's given several ultimatums. He's extended the deadline. And the question was, would the Iranians retaliate or would they reciprocate? Now what it looks like they've done is retaliate, and so it will drastically reduce the market's confidence in the ability of the president to do a diplomatic solution. So if he actually, and I'm not sure that I believe this report that's going around saying, that he would pull out without clearing the strait. But let's say he did, that means he's putting the onus on Iran, and Iran would then look like they're the bad guy because they're the one attacking shipping. But if they continued to attack shipping, well, that would impede the oil flow and push up the oil price, and he'd have to re-intervene. And so it's just not a very credible report. The only thing you could have is maybe both sides are just winking at each other, and the Iranians stop attacking ships while the president stops the assault, and that would effectively be backroom negotiation.
So what is the likely off-ramp? I mean, and is it still one off-ramp? Or, to your point, can we disentangle the two now? The global energy story and the actual political objectives that they had originally between Israel, the U.S., and Iran.
Right. So if you're looking for like an end game, the United States is definitely going to assert control over the waterway and free passage. And it has the capability of doing that. And again, with allies in particular, it would ultimately be able to do that. The question is, can it do it without such an extensive energy shock and economic shock that we end up with a really negative global economy and instability, and obviously that's not part of the objective. So there can be a sort of tacit agreement for the U.S. to call off the assault. And then if the Iranians stopped attacking shipping, then that may be a temporary solution. But of course, ultimately, the U.S. also wants to prevent Iran from getting a nuclear weapon. And one key demand that they will continue to make is that at least that they find the highly enriched uranium that is unaccounted for. And the Iranians may not give that up. And so the fighting could then escalate later, particularly after the election when the U.S. doesn't care as much about the oil price.
The news this week, Matt, was the Houthis have entered into this conflict and that, the Red Sea is now at risk of seeing what we're seeing in the Strait of Hormuz. Do you see that? Do you see that this next chokehold is going to be at the Red Sea?
I don't think that'll be the important one, but yes, it could definitely escalate, and you could have some ships struck there, and that would certainly add to the sense of panic in the markets. But investors should stay focused on Hormuz. That's what really matters in terms of volume, and that's where you don't have alternate entry and exit routes. So that's the true bottleneck. With the Red Sea, you can always go around Africa. There's multiple entries and exits. So also the Houthis just don't have the same capability, and countries have been dealing with the Houthis for a while. So it's sort of a sideshow. It could add to some of the negative sentiment, but really what we need to see is Iran and the U.S. and Israel stop targeting critical shipping and energy infrastructure. And if that's happening, even if they're still hitting each other's military bases or things, the market will tend to look through it if they think that there's that silent agreement to allow oil to reach the global markets.
There's a massive ground force U.S. ground force that is building in that part of the world. Just lay out what you think we should be expecting as far as that specific card is concerned.
Yeah, generally there's zero chance that the U.S. is going to invade in a large-scale way. This is not a ground operation to hold territory for a long time in Iran. You could use special forces, and if you had the intelligence and the confidence that you could seize the highly enriched uranium, then that would be a very clear use of special forces, although also extremely risky. But the other thing you could do is maybe you could provide better targeting for U.S. forces, particularly with regard to the drone making capabilities in the drone launch sites, because that's a tricky thing. And as we just saw, this Kuwait tanker was hit by a drone. Drones are hard to stop. But you're not talking about the number, 5 to 15,000 forces or Marine expeditionary units. These are not units that are designed to take and hold territory for a long time, and they're not large enough to do that against, Iranian armed forces. So, and then finally, like with Karg Island, you hear people talk about, well, that's sort of like going for the jugular vein of the regime. You would be cutting off its oil revenue. But you could bomb Karg Island if that was your intention. You'd massively escalate the conflict, and they would retaliate against energy infrastructure. But you don't necessarily need to put boots on the ground for that mission. So I think it'll be selective and surgical, and it'll be special forces if it happens.
And do you think, Matt, if that is the case, is the U.S./Israel, are they any closer to the broad objectives of either or both regime change or deterring Iran from pursuing nuclear weapons, which after this, I can't imagine how Iran wouldn't be tempted at having those as a deterrent?
Yeah, it's tricky. They have been pursuing nuclear weapons. It's debatable, but they had a very highly enriched uranium stockpile that they'd been developing, and they'd been developing ballistic missiles. So, you can go figure on that one. But the Operation Midnight Hammer really set back their nuclear program, and now they've been also punished severely. So the idea is that they've been set back, and it could be that the U.S. and Israel could have to pursue similar operations in the future if they keep returning to an attempt to build nuclear weapons. But there would also, remember, their economy has collapsed, and they have and will continue to have enormous social unrest. So it's not clear that the regime will pursue the same strategy going forward. And in the end, as I'm saying, the U.S. and its allies will be able to take Hormuz back. The only question is whether they can do it without a major global slowdown or recession. And it's looking unfortunate on that front. I mean, I think the markets are still in for a rude awakening as to the full economic ramifications here.
Yeah, what does that mean for oil prices then, Matt? Do you think that, 100, I hear 140, I hear 200, if this keeps going on and is a prolonged sort of conflict, will we ever get back to kind of sub 100 oil?
Yeah, well, so we have to think in scenarios here. Right now, the president offered an off-ramp and a diplomacy, and the Iranians did exactly what they were, threatening to do and not supposed to do, which was they attacked an oil tanker. So right now, I think we're going to go back up to 120, and we could even have a melt-up phase if this is not resolved over the next 2 weeks. And that a melt-up phase could be really hyperbolic. I mean, you could end up with oil going up to 150, 180. But at that point, you're killing global demand, and it's going to end up coming right back down as global consumption is damaged and the global economy contracts. And so what the best case scenario here is you end up in negotiations, but then you're still got an uncomfortably high level around 100 as everyone hoards oil, trying to make sure they have a stockpile in case fighting reemerges.
Matt, it's great to have you. Thank you. Matt Gertken there, Chief Geopolitical Strategist at BCA Research. Well, plenty more to come. This is Bloomberg. Let's take a look at shares of CanSino Biologics, the vaccine maker in China, here today. We're just slightly lower by about a third of 1%. Earnings did come out. The company has swung back into the black for the full year, but its net income during the period came in below analysts' estimates here. Joining us exclusively from Tianjin now is the company's chairman and CEO, Xuefeng Yu. Dr. Yu, thank you so much for joining us. Before I get to the earnings side of things, I wanted to get your take on what's going on in the Middle East. I know the company has signed deals to commercialize vaccines in the part of the Gulf nations like Saudi Arabia, UAE, to really localize production there. Can you give us an update on where those plans are?
Yeah, certainly what happened in the Middle East is a concern for everybody. We are the vaccine company. We provide healthcare, solutions for the region. And so far, the business is still going on as we expected. And I hope what happened in the Middle East will not interrupt what the people needed for the healthcare product, like vaccines.
Okay, Dr. Yu, so suffice to say, no impact, no change of plans currently for you guys, and no direct or at least material indirect impact to the company, just to close that loop.
No, we are moving forward as we expected.
Okay, let's talk about plans then. So, tell us, how satisfied are you with the results from full year of last year?
Well, we delivered our promise as we expected. We promised last year we want to achieve break-even status for our, financial readout. And the end of the year, we actually achieved a small amount of profit, which, considering the challenge environment in Chinese vaccine market, given the birth rate continued decline, and also the economic challenges, I think we're happy with what we have achieved, especially our leading product, Malaysia, which is the pneumococcal meningococcal conjugate quadrivalent conjugate vaccine. We have delivered a solid revenue growth on this product. I'm happy to see in the third year we actually achieved a 1 billion yuan renminbi revenue on this single product.
Yeah, I mean, breaking even in 2025 certainly is a milestone, Dr. Yu, but the broader vaccine industry in China seems to have been struggling. You talk about vaccine prices have been on the decline. Industry associations have been warning about involution in that front. Does that change at all your strategy and what sort of vaccines you develop?
Well, the business always challenges. We see the birth rate, I just mentioned, the birth rate is coming down, and overall new birth cohort is only, 8 million some numbers. However, the government also try to cut the price or due to competition. However, I think we have to see the bright side. If we read the recent the 15th five-year plan, we actually can see the government promote the old age healthcare and also disease prevention. We can actually see the distribution of vaccine coming to the community clinics. This has been a kind of a model system tested in a few provinces in the past few years. Now we see it become a national policy. I think if we look at the bright side, we certainly see the potential expanded market, and the value of vaccine will be realized for all the ages, especially dealing with the aging population in China.
Could you tell us more about that, Dr. Yu, the specific opportunities in as far as vaccines that you make or that you're probably looking now to explore because of that longer-term objective of the government? Just, I guess, let's look beyond the next year or two. How does that look to you?
Well, I think CanSino is positioned well in the old ages, disease prevention. If you look at our recent extended our licensure, indication to from Malaysia to 4 to 6 years old, and our clinical data for 7 to 59-year-old already complete the clinical trials. We're compiling data, submit to the regulatory agencies very soon, and we certainly develop vaccines for the old ages. And this will also apply to our pneumococcal conjugate vaccine, diphtheria tetanus component pertussis vaccine. We have already obtained these accelerated review for our pediatric indication for diphtheria tetanus component pertussis, and we also complete our 4 to 6 years old the booster dose, and adults indication is on the way. So I think if we look at our pipeline, we are aiming for provide protection for old ages. If we look at the Chinese policy in the past, our EPI program in the past primarily focused on the infant to up to 6 years old. But with the new government announcement or the 15 five-year plan, we certainly can see the government is looking into the old population, the aging society, how we can provide better prevention for disease, for the old ages. So that's why we can see this policy is changing geared towards old age coverage. I think this provides a great opportunity for vaccine industry. If we position our product well, we can provide much broader protection to everybody.
Dr. Yu, as always, thank you for speaking with us. We always appreciate, of course, you taking the time to do so. Dr. Xuefeng Yu there, Chairman and CEO of CanSino Biologics. Just talking us through, of course, some of the opportunities that just beyond the next 12 months presents. Pretty strange to go from vaccines to booze, but here we are with Maltai on the up on the back of that price hike, first one in 3 years. More in the markets just ahead. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break in just a moment. And looks like a little bit better here. We're actually flat now when it comes to Nikkei 225. Topics is actually catching a bit here this morning. Not much movement from dollar yen after, of course, the rhetoric that we heard from officials yesterday here. So we're still sub 160. But keep in mind, we do have a 2-year bond sale later on today. And given just the pressure for the BOJ to hike in the face of this energy price hike, that's certainly going to be a key question on what demand's going to look like here today.
Okay, watch out for that. Markets have been all over the place. This morning, we gapped lower substantially at the open of some of the markets that up and running very early. And then once most markets had opened up, we were basically treading on fairly good news and have since actually gone back the opposite way, which is down. Let's call things we're down just ever so slightly on the benchmark. U.S. futures, though, as you can see, are still holding on to gains, so it's still more the positive side of the story that investors are latching on to right now. And I think the best read of this would be the bottom row, the Bloomberg Asia Dollar Index. What that color effectively shows you is, I guess, the mood of the moment across these markets. Okay, let's bring in Ting too, our Asia Equities Managing Editor with us out of Singapore. They've been following, your team has been following the gyrations of what's been taking place this morning. Are we on better footing now than at the open? Ting is my first question.
Yeah, I think the WSJ story definitely gave the market a positive boost. But we have heard since plenty of investors are warning that this kind of positivity may be quite short-lived. We've seen such episodes many times before. I think overall, it is probably a better situation than Trump's rhetoric about obliteration last night we heard regarding Iran. But still, the picture is getting more and more murky in terms of imagining how this Iran war could be ended in a very clear fashion and how we can quickly restore to the energy flow situation that the world was before this war. I think a lot of sort of caution still very much in play here. And one thing that is really playing out today was also the semiconductor sector. That was, the engine that was underpinning Asia's outperformance leading up to the war. So I think just a variety of factors weighing on that sector, including, of course, higher rates and potentially slower growth, but also, the month-end flows. That could also mean, people are really taking profit again very violently on a sector that has been performing so well. So we'll really need to see what kind of sentiment was, maybe getting more of a clear picture at the beginning of next month about this AI sector.
Yeah, and I think Korea is a clear example of that, right? That it became one of the investor favorites to one of the worst performing markets out there this month. As we wrap up this crazy March madness of the last few weeks, Ting, I mean, we're talking about $11 trillion of value of global stocks have been wiped out in just 1 month alone. What are people saying to you now about what the next few weeks are going to bring?
I think people are still very much cautious, right? As I mentioned, it is really hard to just abruptly end the war with all parties agreeing on a deal. And people are sort of thinking, how do we avoid sharp downside, but also start to position for a potential upside? And that timing is really difficult, right? You don't want to position too early, then you suffer more losses. But at the same time, you also want to position for some sharp upside, just because it could easily happen with some kind of strong rhetoric coming from Trump. So that is the kind of balancing act a lot of investors are sort of game planning right now. And of course, China continues to be an area of focus. This month, China did have its resilience outperforming global stocks by the most since 2025, in August 2025, I should say. So, that kind of resilience may still play out just because more and more sell side and buy side are weighing in to have the same call that we saw in the last week or so. BNP and Goldman both talking about how people should be cautiously adding more to the China position. And the China story is getting a little bit more interesting. One data point I wanted to mention was that even before the war, global long-only active fund managers were actually adding positions in China. Remember, we had a long period of underweighting sort of stance held by global fund managers leading up to sort of February this year. And in February, finally, we saw kind of that positioning turning neutral for the first time since 2022. So we did see some kind of gradual warming up to Chinese assets even before the war, and the war obviously has added to the appeal of Chinese assets.
And it's really taken away from a market like Korea, which, on up days seems to be relatively underperforming. On down days, it's really to the downside. You guys have a really good piece in Korea today. Where does this leave Korea going into the second quarter now?
Yeah, the Korea story is getting really murky, right? I think this month we're seeing 17% also sell-off in Korea. Again, the AI story is getting a bit weaker, or people are turning more sour on this story. As I mentioned, there is just a variety of factors weighing on the sector. And overnight, the big sell-off we saw in the likes of NVIDIA and Micron really show that people have decided decisively turned negative on this Korea story, because also Korea is one of the most exposed countries to the shutdown of the Strait of Hormuz. So going forward, we've heard very few people talking about buy the dip or adding positions at this very moment. And some people have already said that they are waiting to see the picture to be more clear, maybe towards the end of this year or even next year, before they rethink or before they think of buying again Korean assets.
Ting, thank you, Ting, too. They're our managing editor for Asian Equities, joining us out of Singapore this morning. And coming up, we have our exclusive conversation with 01.AI CEO Kai-Fu Lee on what he's seeing in the Chinese AI space amid this open claw frenzy. And of course, maybe talk a little bit more about this sell-off we saw here in Asia and the U.S. overnight. This is Bloomberg. Welcome back to some corporate news this morning. Chinese property giant Country Garden returned to profit in 2025. The company has reported net income for the full year of nearly $472 million, compared with a loss of $4.7 billion a year earlier. Country Garden has been at the center of China's property slump and says it's been in a no man's land of complexity and uncertainty as it restructures. Blackstone is said to be launching its first hedge fund for affluent individuals, intensifying a push to attract professionals with disposable income. Sources say the multi-strategy hedge fund plans to start trading this year, open to clients with at least $5 million of investments. Alternative asset managers have been searching for sources of capital beyond traditional institutional backers. OpenAI's initiative to let companies launch mini apps within ChatGPT is off to a sluggish start, with app makers citing a tedious app approval process and limited functionality. The partner companies are hesitant to hand off customer relationships and payments to OpenAI, and many apps require users to leave the chatbot to complete a purchase. The move, announced last year, looked to be a key step towards OpenAI turning ChatGPT into an all-in-one platform.
Okay, let's talk about this new disruption of what was previously, as recently as 2-3 weeks ago, the disruption that was causing this ruckus across these markets, right? So you have this massive sell-off in software and memory, in fact, overnight. Micron got absolutely tossed out the window. You're seeing that play out across the Asia-Pacific in Korea, which seems to be moving along the lines of that story more than what's happening. Of course, Iran is not helping, but it is also seeing some downside right now. And a lot of that also has to do with markets are trying to figure out whether this new announcement from Google actually then displaces what was formerly the darling, which was HBM. Right? And do we have to go back now to, I think it's Flash, if I'm not mistaken. Anyway, my memory's not serving me correctly here. Belle is with us here to help refresh because this is an ever-changing
It is an ever-changing story, and actually on the topic of memory, it's really at the center of it as well. But it has been, to your point, I think people are just really trying to wrap their heads around this new turbo quant that's been released by Google. And some people are comparing it really to the DeepSeek moment of last year, even though it has just been released or publicized. Actually, it was released at the end of last year, but it's starting to pick up a lot of interest in the last week or so. But it could be a significant research breakthrough. And the issue just in AI generally and how LLMs are deployed essentially is that memory becomes quite a significant bottleneck, because what you're asking these LLMs to do is to have a lot of recall functionalities. So you want to have an in-depth conversation, you want it to analyze lots of documents, or you want it to remember everything about what you've spoken about previously, and that takes a lot of memory. What TurboQuant is saying is that we can reduce the amount of memory that's required by a factor of 6, and we can also give you the same product as you had before. So, as in the performance I'm talking about here. So, yes, initially the market was very much focused on, does that drive down demand potentially for HBM? Now overnight it's a changing assessment. People are a lot more focused on the flash side of it, which is essentially the high capacity storage that flash NAND or NAND flash does actually provide for it. HBM, they're saying, maybe it still is really critical just because you've got that raw processing speed that's required for AI training and inference. TurboQuant is only focused on the inference side of the AI story. But regardless, there are a lot of technical details. What I will say is that you saw really overnight it was the flash story that got hit in particular. And actually, I think you're seeing that kind of reflected, or you have been seeing it reflected in the session so far, even though I take a look at those moves here. You're under pressure. You're not under pressure to the extent of what we saw on Wall Street.
There's concerns, though, within the memory chip space of now excess capacity. Tell us a bit more about who's the most vulnerable right now.
Yeah, excess capacity is certainly going to be an interesting one. I think it really comes down to, I guess, questions really around, I guess, the capacity of some of the Chinese makers in this space. We have seen, in terms of the types of memory foundries, obviously different capabilities of each, and good point on that one. But I will say as well, I mean, there's been a lot of questions around, demand that we're seeing for certain stocks as well in Asia, and Kioxia in Japan has, of course, been one of the most notable, given you've seen a huge amount of turnover in that stock as well.
All right, Belle, thank you. Our Asia tech correspondent, Annabelle Jewelers there. I just want to bring you the latest when it comes to what we're hearing from the Middle East. So this is according to Tasnim. So they are now reporting that there's power outage hits east of Tehran following explosions. So that is sort of what we're hearing right now of what we're seeing near Iran, east of the country there, power outages and the like. We're not getting too much more beyond that, just that headline here right now. Yeah.
Once we have more information, we will bring it to you, but you're right. But what is clear is that things are still happening despite the rhetoric that you're getting publicly from some of these reports. The Journal, of course, which was key really to this market reversal a few hours back, is also something to consider. But yes, we will have more on this once we have more information on this a bit later on. Okay, we will just take a short break for now, and then we will just update you guys on many things happening as far as the oil and macro story is concerned. We had some updates coming throughout in the Philippines. We'll get to that all on the other side of this break. But yeah, in the meantime, markets are actually on better footing compared to the start of the day. Lots more ahead. All right, more on the inflation story. An update out of arguably one of the worst hit economies, which is the Philippines, the central bank on the inflation front, that this doesn't even get you into the demand side of the story. The last reading for Feb came in at 2.4%, so it was actually on the up, as you can see there, which had come substantially down from the high days of, I think, 2021, 22. This latest month ahead projection, which came in, I would say about an hour back, suddenly puts the inflation print back above, not just above the 3 handle, right? The upper end of this projection takes you back, if I'm not mistaken, more than 12 months back to 3.9%. So this is a full, if indeed that comes in at the upper end of that conversation, now takes us to about a percentage point and a half above an already climbing inflation print, which I guess this scratches the surface. I think it's the point that Sok Jin was making earlier on. It's actually a good thing if it's only inflation that's the problem, right? But some economies don't even have the choice, don't even have the access to the supply on things like oil.
And I think the Philippines is one clear example. I think they said that in terms of stockpiles, they have, 45 days or so?
Or less.
Or less now. Certainly, they are the more vulnerable side of things here. And really what we heard from, I remember Jim McCormick from Citi, was that, this whole stagflation sort of scenario is something that you really maybe a few weeks ago was not a distinct possibility. But you really have to think about it now. And you talk about the trajectory of prices, right? I mean, you've been charting this as well, that, we might be seeing something that we saw from the U.S., right? From just a few decades ago. So certainly there is going to be a lot of questions about where the inflation story goes. The jobs report certainly is going to be one thing to watch the U.S. on Friday as well, right? Is that still going to be the key issue, or are we going to be really tilting more to where the inflation side of things here right now?
This was one of the scariest charts I've had to sort of recreate, and hats off to our colleagues at Functions for the Markets, right, FFM. And what this shows you in white is the current current U.S. inflation trajectory from 2015 up until right now, which is, as you can see, below the blue line, which is the trajectory back in the 60s all the way to that oil spike because of the oil embargo and that major shock that we had back in the 70s. And the question here is U.S. inflation mirroring what we had back in the early 70s? Of course, lots of other factors are involved this and now, but I guess in some ways this hopefully would not be history repeating or rhyming itself. I think just to put it out. Anyway, that's just something to look ahead to. And hopefully that doesn't continue in that trajectory.
Yeah, let's get back to the tech story in a moment here, because people still think this whole AI boom can still continue amidst all this volatility around oil prices and the like. Certainly the big focus has been today about, as Belle mentioned, the roiling of the memory side of the trade here and what this means, given that you have some of these new tools that is maybe requiring less memory to kind of deploy when it comes to some of these AI ambitions. Our next guest is the CEO of agentic AI platform 01.ai and chairman at venture capital firm Sinovation Ventures. Kai-Fu Lee joins us now. Kai-Fu, it's always great to have you. It seems like every day the AI narrative sort of changes. One day memory seems to be the hot topic, and then the whole roiling of software. I mean, where do you think we are now in this whole AI boom?
Well, the AI is going to be the most important technology revolution in the history of humankind. So these ups and downs, memory prices, are just little blips along the way. I wouldn't even worry about it.
Okay, and what about, Kai-Fu, markets are trying to figure out whether the displacement or replacement across sectors, software keeps coming up recently. Are markets getting this one correctly, or are we getting ahead of ourselves here in terms of the specific subsectors where AI might really make itself felt?
Yeah, it's not exactly simply a displacement. So the software engineers who used to take orders and write specific code to specification, that job category is going to be largely gone because AI can do that better. But the software architects who can orchestrate and plan and integrate and understand data and users, the value of these people are going to shoot through the roof. So at 01.ai, we we are really building an incredible software team that has the ability to do critical thinking, large project management, architecture. So our software engineers are getting 10x productivity than they were before. And we'd love to add more people. So I think the skill sets have shifted. It's kind of like people who used to draw pictures for marketing brochures. That's going to be largely replaced by AI, but people who can conceptualize what kind of pictures will appeal to people and represent the company better, their value will go up. So it's a giant shift of skill sets and also talent mix.
Kai-Fu, you're in Beijing. I'm just wondering what you've been seeing in terms of this phenomenon, which is open claw, which China has embraced and welcomed with open arms. What are the opportunities and what do you see are the risks?
Right. So open cloud is very much akin to Linux. I remember the days when I was at Microsoft, where Microsoft was dominant, and this Linux came up, and it became the rallying cry for the super smart, but sometimes anti-establishment and also poor engineers. And eventually Linux took a giant market share, although Microsoft still makes the bulk of the money. So I think open cloud is the same rallying cry against the American large language model companies who overcharge for the products and APIs they have, and that was okay for wealthy companies that have to buy the best model, the best API, best software. But when it comes to the professors, entrepreneurs, hobbyists, students, they very much welcome using this new agentic open technology, which is akin to open source, akin to Linux. So it is a great fit for the non-elite, top-tier market dominant players, and that means a lot of the middle class, smaller, younger people worldwide, and China is full of them. So I would say the combination of open source models and open cloud gives China a great opportunity to reach users worldwide because the Chinese models are cheaper and Chinese apps can be built on this open architecture, so it's bound to take off. Now, that said, it does have a lot of security flaws and issues and imperfections. It's new, so it will get fixed over time.
Kai-Fu, big trends that I'll put this together with, of course, which is somewhat related, of course, the pickup in token exports, for example, and the build-out of Chinese AI infrastructure to the world. How does that affect how you think about what you guys are doing? What's cooking in your kitchen?
Zero1.ai is singularly focused on building enterprise solutions. So this very much follows the Chinese State Council direction that AI Plus, which is helping traditional industries, is going to be the most important part in China. And we actually do that in China and worldwide. And our model is building a platform that makes it very easy to build not any application, but mission-critical applications that move the needle on the bottom line. So we're focused on building applications for large enterprises that are making a big difference in the company. For example, helping to improve the revenue, the profit, speed of execution, time to market, or letting the CEO see a full view of the company and make smarter decisions. Yeah, that's what we focus on today.
Kai-Fu, I'm afraid we had to leave it there. We've been pressed because of all the breaking news taking place. Apologies for cutting this short, but let's do this again, please. Kai-Fu Lee, Zero1.ai there, and of course, CanSino Ventures Chairman. We have lots more ahead here on Bloomberg Television.